Uber has become a global phenomenon, operating in over 900 metropolitan areas worldwide. From a simple app that promised your personal driver, Uber has expanded into various sectors like food delivery and freight services. Despite this global footprint and diversification, Uber continues to post losses, a fact that baffles investors, analysts, and consumers alike. One of Uber's most significant expenses is driver compensation. As of 2021, Uber had approximately 5 million drivers worldwide. The company has to maintain a delicate balance, pay drivers enough to keep them engaged, but not so much that the rides become unaffordable for customers. Other expenditures include incentives and promotions to keep both drivers and riders using the app. Compliance with local, state, and national regulations across multiple jurisdictions is a logistical nightmare and a financial sinkhole. In cities like London and New York, Uber has faced legal battles that resulted in substantial fines and, at times, temporary suspension of services. In 2019, London refused to renew Uber's license over safety concerns, a decision that took months of legal wrangling and substantial costs to overturn. Uber's price war with Lyft in the US is a well-documented financial drain. The push to outdo each other in promotional offers and slashed prices leaves both companies operating at a loss. To illustrate, in Q2 of 2019, Uber reported a staggering $5.2 billion loss, while Lyft posted a $644 million loss in the same period. When Uber cut driver pay in several US cities in 2015, the backlash was immediate. Protests erupted, and many drivers quit or switched to competitors like Lyft. This example demonstrates the precarious nature of Uber's relationship with its drivers. The cost-cutting measures that benefit Uber's financials can simultaneously weaken its operational backbone. Amazon's entry into the ride-hailing market in select cities and Google's Waymo investment in autonomous taxis exemplifies the competitive pressure from companies with more diversified revenue streams. Unlike Uber, these companies can afford to operate at a loss in the ride-hailing market, subsidized by other profitable operations. In 2016, a study by the National Bureau of Economic Research revealed that an average Uber user would be willing to pay more than the current fares. However, due to the lack of differentiation with other services like Lyft, increasing prices could drive customers away, forcing Uber to engage in a race to the bottom. Surveys have indicated that customer loyalty in the ride-sharing sector is often price-based. According to a 2018 report, approximately 60% of users have 2 or more ride-sharing apps on their smartphones, showing that users often compare prices before booking. According to Uber's Q2 2021 results, the Uber Eats segment showed a 113% increase in adjusted net revenue year over year. This suggests that diversification could be a viable path to profitability. Uber is investing in autonomous vehicle technology, hoping it could eventually reduce the dependence on human drivers. The acquisition of Postmates' robotics division in late 2020 signals an interest in using automation for food delivery as well. As of August 2nd of 2023, Uber finally turned a profit, and according to the Motley Fool, it's taken 14 years and nearly $32 billion of cumulative losses. But ride-sharing and food delivery company Uber is finally a profitable company. Uber reported a net income of $394 million in the second quarter. Uber's journey highlights the pitfalls of rapid growth and market saturation without a sustainable financial model. However, it's worth noting that Uber has been making strategic changes aimed at long-term profitability, from diversifying into other sectors to investing in technology that could revolutionize its primary service.